Chapters 16 and 17 look at performance measurement, a key topic in management accounting. In Chapter 16, we'll be focusing on the financial aspects firstly, and then when we move on to Chapter 17, we can look at the non-financials. We'll need a balance of both finance and non-financial measures to be able to fully understand how well our business as a whole has performed, or how well any part of the business we might be assessing has performed. In order to be successful in the exam, we should be prepared for both long and short form questions. So sections A and B could both contain questions on financial performance measures. Our starting point is going to be to learn all of the ratios. There's a significant number of ratios we'll be looking at in this chapter, and we can't expect those to be provided in the exam. However, it's well worth the extra effort getting these into your long-term memory, as you're likely to need them throughout your ACCA studies. So worth that bit of extra time in revising these ratios. Let's have a look at our overview and see which key areas we need to know for this chapter. The ratios we need to know for this chapter fall under three main headings. Firstly, we need to consider how profitable our organisation is. So we'll look at a range of measures that focus in on profitability. That will include ratios such as ROCE, our return on capital employed. We'll look at our asset turnover and our return on equity. We'll then go on to consider how liquid our business is. So, do we have enough assets to be able to meet our liabilities? Will we be able to find the cash to pay those bills as they fall due? That's a key question. And some of the ratios that we'll use here include our current ratio and our acid test or quick ratio. We'll also consider how long cash is tied up in each part of our business by looking at our inventory days, our receivables days, and our payables days. Some of these ratios may be familiar to you from elsewhere in your studies or from your practical experience. If they're not already familiar, then hopefully they will be by the time you finish this paper, because you're likely to see them again in later chapters and later papers. Gearing is another key area for us to cover. We need to look at how our business is financed. Are we using equity or are we using debt? If we're using debt, how much? And can we afford to make the interest payments on those loans when they fall due? That's the question that we're asking here with our gearing. There are a number of ways of calculating gearing. We'll make sure that we're confident with how it's supposed to be calculated for this exam, which is looking at our debt over our total finance. We'll then move on to look at our responsibility centres. Now, we already mentioned that there are a number of categories of responsibility centres: cost centres, revenue centres, profit centres. Well, our profitability measures that we've already looked at should help us assess the performance of those profit centres. And we've considered variance analysis, which will help us to appraise our cost centres and revenue centres. But what about those investment centres? We need some new tools. So we'll look at the return on investment, ROI, and our residual income calculations. Two measures to help us. One is a relative measure, a percentage. The other is an absolute. We'll get our answer in pounds or dollars or euros. We'll need not only to be able to calculate these, but consider the strengths and weaknesses of each measure. So we'll consider the relative advantages and disadvantages for each measure so that we can deal with those narrative questions as well as the calculation-based questions. As we start looking at financial performance measures, our first challenge is going to be to get our heads around all the different ratios that we're expected to know. Now, it may well be some of these are already familiar to you. They're common ratios that you may have come across either in other papers, elsewhere in previous studies, or in your work life. However, I'm going to assume that you haven't seen any of these before, and we're just going to run through each of them in turn. As you can see by the symbol on the side of the page, you're expected to learn each of these ratios. They are not going to be provided for you in the exam room. The first ratio that we're going to look at is ROCE, our return on capital employed. In order to calculate ROCE, we'll take first our profit before interest and tax, which we'll refer to simply as PBIT, and divide it by our total assets less current liabilities, which we can call TALCL. Now, TALCL is simply a way of calculating the total amount that we have invested in our business. Now, that could also be calculated as the total equity plus any long-term borrowings we have, so any non-current liabilities. Put simply, that's the amount that we owe back to our investors, which should always be the same as the total assets in the business, less paying off those current liabilities we have outstanding. Okay. So ROCE tells us overall how profitable our business is. We can break that down into a couple of separate components. Profit margin. Profit margin is our profit. Again, we'll use the profit before interest and tax figure. The reason for that is that the interest and the tax arguably is mostly uncontrollable. We have very little control over the amount of tax that we're going to have to pay, although obviously if we listen to recent news stories that might tell us differently, but we can assume for the exam that we have little control over the tax that we're paying, and the interest really is tied up in those long-term finance decisions, so arguably there's little control there as well. So we'll take this controllable profit figure, our PBIT, and we'll divide it simply by the revenue to say for each pound of sales that I'm getting, how much profit do I make on that pound of sales? What proportion of my revenue comes through as profit? So it tells me how good I am at generating profit from each individual unit sold. The other side of our ROCE is the asset turnover. How good am I at selling things? For that, I'll calculate my revenue, my sales, over the resources that I had available, those total assets less my current liabilities. Now I just want to show you for a moment, stepping away from the notes, how these ratios fit together. So if we think of ROCE as telling us overall how profitable we are as a business, and we think that that's made up of two separate things. One, am I good at generating profit from each unit sold? In other words, my profit margin. And two, the second component, am I good at selling things to begin with? Am I good at using my resources to generate sales? We'll call that our asset turnover. Now we look at the calculations themselves and how they fit together. We said ROCE was simply PBIT over TALCL. Okay, that's made up of our profit margin. We said PBIT over revenue multiplied by our asset turnover, revenue, over my total assets less current liabilities. If we look at those calculations, because revenue appears on the bottom of my profit margin and the top of my revenue, we can see then that that's the same as multiplying PBIT over TALCL by 1. In other words, there's no impact. The two revenue figures cancel each other out. So it doesn't just make sense in terms of the meaning of the ratios, that how profitable I am as a business is dependent on my margins and my abilities to make sales, but it also makes sense mathematically to us. The last ratio that we need to know for profitability is our return on equity. That's simply calculated as my profit after tax and preference dividends. Now, we're taking that profit figure because it's after everybody else has had their share of the money. So the bank has received the interest on the loan, HMRC has received some tax, and the preference shareholders have received their dividend. The money that's left over is owed back to our equity shareholders. So here we're looking at the return that we're getting just for those equity shareholders. When we think about financial performance, we typically focus on profits first. Clearly, if we're going to be successful, we need to sell things for more money than it costs us to make them. But even a really profitable business can struggle if it hasn't considered its liquidity carefully enough. So here we focus on a number of ratios to help us measure liquidity. The most common of these is the current ratio, a very simple calculation of the current assets divided by the current liabilities. So our current assets would include things like cash. Any balances that we have at the bank, for instance, would be included, or cash held on site. Will include inventory. And we can include our receivables. Money that our customers have promised to pay us but haven't paid over yet. Our current liabilities would obviously include things like our overdraft and money that we may owe to our suppliers. So the question is simply, do I have enough of those assets to meet my liabilities when they fall due? Can I pay my suppliers when it reaches the 30 days of credit that I have on the invoice? The problem, of course, with that is we're assuming we can use all our current assets to meet those current liabilities. Well, I'm going to have difficulty paying my suppliers using my inventory or the promise of cash from one of my other customers. Instead, cash is really the thing that I need. Inventory is the least liquid of my current assets. The promise of cash in the future from our customers should be coming through hopefully within a reasonable time period. But inventory, well, we might have to do some further work to some of that inventory to get it to a saleable condition, then find somebody who wants to buy it, and finally wait for them to pay us the cash before I have something I could pay to my supplier. So in the quick ratio or acid test, we take out inventory from the top half of our calculation. Otherwise, it's exactly the same as the current ratio. But we remove inventory to be a little prudent and say, well, I can't realistically meet my current liabilities using that asset because it's going to take too long to turn it into cash. Other important measures of liquidity would be to look at our inventory, receivables, and payables days. With inventory days or inventory turnover, we're looking at how long our inventory sits in the warehouse. So we'll calculate that as inventory over cost of sales multiplied by 365. That tells us on average how many days it's sitting in the warehouse. Alternatively, we could look at our inventory turnover by dividing our cost of sales by our inventory, see how many times we're using that inventory up during one accounting period. Our receivables, we look at our average figure for trade receivables and divide it by the credit turnover, my sales on a credit basis. We may well be given just one figure for revenue or turnover, in which case we'll use that and assume that the vast majority of our sales were probably on credit. If we don't know the breakdown of the figures, it's reasonable to make that assumption in the exam room. With payables, we take our trade payables, the amounts owed to our suppliers, and divide them by the credit purchases. Again, if you're just given one figure for purchases, assume all the purchases were on credit. Finally, we have our gearing calculations. These help us consider whether our business has the right balance of debt and equity finance. Later in your SEMA studies, you'll consider the benefits of debt finance and equity finance, and consider various theories of how much debt or equity we should be using. At this level, we simply need to understand the calculation. Here it's given as debt over debt plus equity. In other words, the proportion of debt finance to the total finance in the business as a whole. While some debt is helpful to us because it's a cheap source of finance when interest rates are reasonable, too much can be difficult, in particular because we may struggle to meet our interest payments. So the second calculation looks at just that issue. How comfortably can we pay our interest out of our available profits? So we'll take profit, again that controllable profit figure before interest has been deducted or tax, and divide it by the interest charges. Say how many times could we pay our interest using our available profits? Well, that may seem like a long enough list of ratios, but in fact we could be given more than that in the exam room because we also have to consider our non-standard ratios. The lecture example that we're going to have a look at in a moment will give us some examples of non-standard ratios. The key thing to remember with these is not to be thrown by them in the exam and think, oh no, I haven't learnt it. You're not expected to have learnt these. You're just expected to be able to follow the instructions and produce a sensible calculation. So the instructions in the exam should be very clear on exactly what it is they want you to calculate. In lecture example 1, we're asked to calculate a range of ratios, including our return on sales, which is asked for as a net profit percentage. In other words, we could see that as the net profit margin. We're also asked for the gross profit margin and the return on capital employed. 3 of our standard ratios. In addition to those standard ratios, we also have some non-standard ratios: sales per employee, average production cost per book, and average number of books produced for each employee. When you see that word per, it's easy to get from there to the calculation that we need to do. If we simply strike through the word per, we can see our calculation. Sales over employees, average production cost over the number of books, or average number of books over the number of employees. Take a moment now to read through the information in the question and think about how you would start your calculations. Some of the information has been provided, but we may have to do a bit of digging to find some of the numbers that we need. So pause the recording here to see if you could start your calculations. As you've hopefully noticed, the first figure that we need is our sales to be able to calculate the return on sales or net profit margin. That figure isn't given to us in the question, but we are told our production cost in total and the gross profit for the year. If I were to add back my gross profit, I should be able to work out the total value of my sales. It's not unusual in the exam to have to do some calculations like this to find the figures we need for our main ratio calculation. If you feel confident now, you can pause the recording again and attempt the main ratio calculations. If you need to, you can refer back to your notes to double check the way to calculate the ratio. Let's take a moment now to consider the limitations of using ratios to measure performance. One of the key problems that we have with ratios is that on their own, they provide very limited meaningful information. So if I told you I've opened up a new business and in the first quarter of trading, we've been generating a profit margin of 40%. Well, you might look at that 40% and maybe you think that that's a good number or a terrible number. Without some context to sit it in, it doesn't mean very much to us. If I knew that last year, we had in the same quarter generated 50% in our margin, then we'd be looking at that 40% and thinking that wasn't terribly good news. Or maybe we could compare it against a competitor. Maybe our competitors are generating margins of about 35% because trading conditions are very difficult at the moment and everybody's had to lower their selling prices. That gives us a fuller picture. We can now judge that 40% against something. But on its own, if we take those away, it means very little to us. It's also important to make sure we're comparing like with like. We need to know exactly how the ratios should be calculated. We need very clear definitions for each of them to ensure that we're all calculating on the same basis. Otherwise, those comparisons I was making between this year and last, between myself and the industry average, have very little use to me because it may be that they have defined their profit figure differently. If we're comparing our performance over a number of periods, we need to bear in mind the impact that inflation may have had on those figures. Are they really comparable if there's been a significant level of inflation? It's a little bit like those moments where friends and relatives who are perhaps a bit older than you love to tell you how much they paid for their house 30 years ago whilst you're trying to get onto the property market. It might not be a very helpful comparison to hear that they bought a 3-bedroom house for £20,000 because clearly that's not comparable with today's prices. It's not a meaningful comparison. The final point reminds us to consider the accounting policies. We said we must compare like with like, both in terms of the definition, which figures we include, the inflation, but also accounting policies. So what impact does it have if we've chosen to depreciate our assets on a straight line basis this year, but last year we were depreciating on a reducing balance? Has that changed our profit figures and therefore our profit margins have been affected? As organisations grow, they become more complex, which gives us new challenges in performance measurement. If we think back to 1976 when BPP was first founded, the owners, Briley, Bryce and Pryor, would have had a hands-on part in the running of the business. It would have been set in one office based in London, running one type of course, training for accountancy and tax papers. As BPP grew as an organisation, it started to spread geographically into different centres. So firstly, opening up new offices around London and then moving outside of London to its first regional centre in Bristol. In order to make sense of the organisation, we might want to break it down then into divisions and think of London and Bristol and Birmingham as separate divisions. Or, as the organisation grew in terms of the kind of courses we were offering, perhaps we should break the divisions down based on those different types of course offering. So looking at our law courses as being separate from accountancy and tax. It would be unreasonable to think that one manager should be an expert in all of those different markets. So we use the principle of responsibility accounting, which is where we have this decentralisation in authority. So Briley, Price and Pryor, our original founders, would have to relinquish some control and allow the managers of each of these different divisions some authority to take decisions about how that part of the business is going to be run. Now, this isn't an absolute in terms of decentralisation. You may choose to keep some parts of your business centralised and decentralise others. There are different degrees of decentralisation. However, the same principle would apply throughout. We only hold these divisional managers accountable for those figures over which they have a degree of control. So we need to consider the controllable costs and controllable revenues associated with that particular division. Lecture example 2. Here we consider those larger organisations that have grown to develop their own divisional structure and recognise that each division is a responsibility centre. We have different categories of responsibility centre. We can class them as cost centres, revenue centres, profit centres, and investment centres. Take a moment to consider whether you could complete the remaining parts of this table. Pause the recording here. So if we class our division as a cost centre, what we're saying is that that divisional manager has control over the costs associated with that division. Some costs will still be centralised and based in head office, but there will be a range of costs that the manager can control. They don't control anything else. With our revenue centre, as you might have guessed, the manager now has control and responsibility for generating revenues within that centre. So perhaps they can make local decisions about pricing or marketing, but they have little control or no control over costs. These are perhaps determined centrally. So our car dealer has no control over the cost of manufacturing the car, but they can control the way in which those cars are marketed, and hopefully with an effective sales team, they can generate significant revenues. Our profit centre, well, here we have control over both costs and revenues. In other words, our profit, the net of the two. So the canteen and the car factory is given as an example here. We can control the cost of the food that we're buying for the canteen and encourage factory workers to come and eat in the canteen by offering a tasty menu. Investment centres. Here we have the most control, the most responsibility of all of our managers, controlling the costs, the revenues, and our capital expenditure as well. So let's think how we can appraise performance of each of these different centres using the skills that we've developed so far in the course. If I'm looking at whether costs have been controlled against the budget, the plan, well, that could be appraised with some variance analysis. I can consider my material price or usage variance to see whether we're controlling the cost of materials effectively in our design department. In the revenue centre, we want to consider whether or not we're generating sales revenues. So we could simply look at our sales revenue, but in particular, we might look at breaking that down into some variance analysis again. So looking at the overall sales price and sales volume, as well as the total sales variance. For profit centre, well, we've just been looking at a range of ratios that we can calculate considering profitability. So perhaps a profit margin would be a good measure here. But none of our measures so far have considered the level of capital expenditure in proportion to the profits that are being generated. So that helps us to consider, are we generating the revenues, controlling our costs, and using our resources wisely? In an investment centre, we need some measures that are going to help us look at all of those factors. And so far in the course, we haven't seen those. So we'll acquire some new skills, looking at our ROI, return on investment, and our residual income. When appraising our investment centres, the key thing is to remember that the profit earned must relate to the amount of capital that's been invested. Imagine Brierley, Price and Pryor deciding to expand BPP outside of London for the first time. They got a few of their best staff and put them on the train from London Paddington through to Bristol Temple Meads and said, off you go with this big bag of cash. When they arrived at Temple Meads with their bag of cash, they then had to think what they were going to do with it to recreate the wonder of BPP in Bristol. So they'd need to think, which office were they going to choose? Do they want something out of the centre that's a little bit cheaper? Okay, they could get a bit more space for their money. Or do they want something right slap in the middle of town that's easy for students to get to? So they choose an office in the middle of town that's easy for their students to get to. Then they need to choose their staff, their marketing strategy, their IT equipment. They have to decide how they're going to spend each pound that's in that bag. When Brierley, Price and Pryor want to decide how effectively they've performed at the end of the period, they're going to need to assess their performance against the money that they've spent. So one option open to them would be a relative measure. So to look at a percentage return of the profit over capital employed. Now that should sound pretty familiar because we calculated ROCE, which was our profit before interest and tax over capital employed. All we've done to change our calculation this time is to put the words controllable and divisional at the start of our calculation. So rather than thinking about the profit for BPP as a whole, we're now thinking about how profitable the investment in Bristol has been. Partly because it ties in so closely to that ROCE calculation that we're used to calculating and dealing with, ROI has been a very popular measure. Example 3 looks at News Inc., a publishing organisation producing 2 publications. RN, our real news, and TT, our tabloid trash. We need to calculate some ratios to help us to decide which of these investment centres has been more successful. Pause the recording here for a moment to see if you can decide which you think has been the most successful based on the information we've been given. Remember, we said we could appraise the performance using return on investment. That was calculated as our controllable profit divided by our capital employed. For RN, we know that the profit is 6 million and they had 40 million invested. So that gives a return of 15%. Tabloid Trash created profits of half that, 3 million, but they had less than half invested. They only had 12 million available in their capital employed. So their return in percentage terms is much greater, 25%. If we were to look at who was the most profitable in absolute terms, looking at the total profit, we'd be tempted to say that RN was a much stronger performance, producing double the amount of profit. But it isn't really a fair comparison because TT has had much less resource to work with. In percentage terms, it's fair to say that TT seems to be producing the best level of performance. Over the page, we're given a word of warning. ROI might not result in goal congruent behaviour. We need to think about what we mean by goal congruent. That's a term that's used a lot in management accounting. It's a real focus, making sure that all parts of the business are pulling in the same direction, working towards the same set of fundamental goals. So why would ROI result in decisions being taken that weren't in the best interest of the business as a whole, weren't focused on these same objectives? Let's have a look at lecture example 4 and see if that gives us some clues. Example 4 looks at eWheels, an investment centre for our bicycle retailer Cycle Corp. We're told the divisional profit as it stands is $300,000 and they have capital invested in eWheels of $1 million. We're also told that the target investment return is 20%. We're asked, would the manager proceed with the upgrade that's being considered if their bonus is based on ROI? So we're not specifically asked to calculate ROI, but clearly that's going to be part of our investigation into this question. So take a moment to consider this new investment and the existing level of return that we're generating. Pause the recording and see whether you think we're going to get a goal congruent decision from this manager. A good starting point might be to look at the current return on investment. So we know our return on investment is simply our profit divided by the investment. We're told at the moment the division generates profits of 300,000 and that's over an investment of 1 million. In other words, there's a return of 30%. We could adjust that for the new figures. So let's see what we get as a revised ROI. Well, we still have the original 300,000 invested, but on top of that, 300,000 of profit. On top of that, we've got 25,000 of profit resulting from this upgrade. We've got the 1 million we already had invested, but we'll have to invest an extra 0.1 million or 100,000 in order to finance our new investment. So what happens to the ROI figure? Well, that now comes out at 29.5%. So we need to ask, would our manager go ahead with the upgrade? Given their bonus is dependent on this ROI figure and making the new investment causes ROI to fall, it's reasonable to suppose they would reject the investment. You didn't have to calculate it in exactly that way. Another option would have been to calculate the return of the project on its own. So the project has a return of 25,000 over an investment of 100,000. In other words, it generates a return of 25%. So we need to consider how that compares against the target to decide whether or not we have goal congruent behaviour. So let's look at those figures for a moment. The company has a required return of 20%, the division currently generates an impressive return of 30%, and the project generates a return of 25%. So from the company's perspective, the return of 25% for this project is greater than the required of 20%, so they'd want to see it accepted. But from the division's perspective, the project gives a return of 25%, which is significantly less than the existing return for the division of 30%, so they're likely to reject it. That is why we'd say that this is a non-goal congruent decision. The divisional manager is acting in the best interest of the division, but not in the best interest of the company as a whole. So if return on investment can result in non-goal congruent decisions being taken, then perhaps we need an alternative. Residual income offers us an alternative measure. Rather than a relative term, a percentage-based term, here our measure is absolute. It's measured in pounds or euros or dollars, whichever currency we're working in, but it's an absolute whole value. We're looking at the profit for the centre still, just as we did in ROI, but this time, instead of turning it into a percentage, we'll take off a notional or imputed interest charge, which is going to be based on the total amount invested in the division and the company's cost of capital. So to see that calculation in full then, residual income is going to be equal to our controllable profit less this imputed interest charge, which is a controllable investment, multiplied by our cost of capital. In this worked example, we've taken the same figures that we had in the last example, looking at e-wheels, and instead of calculating the ROI, we've calculated the residual income. So we've taken the divisional profit, 300,000, without the new investment, and deducted an imputed interest charge. So we said we needed a return of 20% on that 1 million that had been invested. In other words, the return we need is 200. We've got a return of 300, so that leaves 100 left over. Let's see what happens when we add in the new project. Well, the profit goes up by the extra 25,000, so 325,000 altogether, and we still charge 20% our cost of capital on the assets that have been employed, this time 1.1 million, so we're demanding a return of 220. Our actual return is 105 more than that. Let's look at what's happened. We're now considering a return of 100,000 versus 105,000. It's now far more likely that our manager is going to accept this project because they can see it generates a greater return for the business as a whole. That would be a goal congruent decision. It would be acting in the best interest not just of the division but of the organisation as a whole. It's worth remembering that even though residual income offers us this stronger result, less prone to non-goal congruent decision making or dysfunctional decision making, residual income is not the most popular of measures. ROI is still far more widely used in practice. Example 5 shows us one way that this topic could be tested in the real exam in a short form question. Fizz Company is a soft drinks manufacturer. They have two divisions, cola and tropical. The shareholders are expecting a return of at least, we're told, 15%. We're now asked to consider which of our managers would receive the bonus for best performance. Firstly, if we were using ROI, and then secondly, if residual income was used to measure performance. Take a moment to pause the recording and think about which answer you would select out of A, B, C and D. So if we use ROI, we know we can calculate that by taking our profit and dividing it by our investment. So I've calculated that as 20 and 25%. So Tropical, with a return of 25%, looks to be doing much better, so it's reasonable to say that under ROI, Tropical would get the bonus rather than Cola. So I can now rule out options A and B. Let's consider the residual income calculation then. So if we take those profit figures and deduct now an imputed interest charge, taking the investment and times it by the company's cost of capital of 15%, we can get to our residual income. So for Cola, we've got a residual income of 16 million, and for Tropical, a residual income of 6.4 million. So if we're looking at in absolute terms, it looks like Cola has given the stronger performance, and so we'd expect Cola to receive the bonus, and select then answer D. Here's an example of another exam style question, one of the more challenging examples that we might come across. Rather than being simply asked to calculate return on investment and being given all of the information we need, we're told instead the value of our residual income. And given some of the information that we need, we're told that cost of capital is 13% and capital employed is 300,000. We're asked from this to calculate our ROI. So how are we going to approach this question? Well, arguably it's quite similar to the backwards variance calculations that you'll have seen when looking at variance analysis. The best trick is to approach it by setting up the calculations in the order in which we're used to them and trying to find the missing pieces of information. So if you were to pause the recording here and set out your workings for both ROI that we've been asked for and residual income that we've been given, put in the numbers that you do have and see if you can find any of the missing information. So pause the recording here and try and find the missing information. So looking first at our residual income calculation, I don't know the profit. That's one of the missing pieces of information. So I'm just going to put a little box there to remind me there's a missing figure that I'm trying to find. I need to deduct my imputed interest, which is my capital employed, 300,000, at the cost of capital, which we're told is 13%. So I can calculate that as 39,000. I'm also told my residual income comes to 6,000. So I should now be able to find my profit. Profit less 39,000 equals 6. So if I add back the 6, I can say profit must be 45,000. From here, we can now go to our ROI calculation and see if we're able to get the final figure. We know that ROI is equal to our profit over our capital employed. We didn't know what the profit was, but having done the first part of our calculation, we now know that it's 45,000. Our capital employed, well, we know that capital employed is 300,000. So 45 over 300 gives me my percentage return, in this case 15%. So 15%, or in other words for this question, we're looking at answer D. Remember, the exam is not just going to test your ability to calculate these ratios, but also your understanding of their strengths and weaknesses. Here we've got a good list to learn for the exam of those advantages and disadvantages of using residual income in comparison to ROI. Residual income gives us a better decision rule, firstly. So it's less likely to result in poor decision making. We saw with ROI that sometimes we might be tempted to choose a project or dismiss it when it wasn't quite in the best interest of the company as a whole. That isn't a danger with residual income. So we're more likely to get those goal congruent decisions. Residual income also gives us a bit of flexibility with the calculation. We can choose a different cost of capital for a project if we feel it's perhaps more risky than other projects we've been investigating. It's not perfect though. Disadvantages of residual income. Well, it's harder to draw those comparisons, in particular when we're dealing with divisions with different sizes. So perhaps we're comparing two restaurants. One's a large restaurant in the middle of a city, another small out-of-town restaurant. If I'm looking at the return in terms of the pounds generated above the pounds that we required, well, that's perhaps not a fair comparison. Percentage return for each pound they had available investment might give us a fairer comparison. A significant disadvantage is that we do require an exact cost of capital for residual income. My accept or reject decision is dependent on having an accurate cost of capital. Whilst you won't be required to calculate one at this stage in your studies, when you get on to F9, you'll need to have a much fuller understanding of cost of capital and how it's calculated. And you'll see then how challenging it can be to develop an accurate cost of capital for our company. Particular mention is given to our marginally profitable investments. So if we have a project that will generate a return and it will satisfy our investors, but not a huge return, then under residual income, we're more likely to accept that compared to ROI. So this is one of the arguments that's used by the supporters of ROI, is that whilst it doesn't always result in goal congruent decision making, there may be some valid investments that are set to one side. They say, well, that's not material. We're still accepting good projects. Okay, yes, some of these marginally profitable ones might have been rejected. However, does it matter too much? That's the argument that people would use to fight for ROI, and clearly they're successful at the moment because it's still very popular.